it's a whole different world today than it was 3 years ago, right?
Yeah, I mean, suits and ties everywhere, so
Yeah.
it's a bit different. Welcome back to SCC. This is day 3,
Yeah.
and we're here today with David from Lotus Lab and Lotus Protocol, and he's going to be talking about one of the most exciting upcoming launches in crypto this year, and we can't wait to hear more about it. But before we get into Lotus and everything, I want to hear about like how you got into crypto and like what was the journey like? What led you to build what you have been building so far?
Yeah, that's great to be here with you guys. Um, well, let's see. Let me take it back. Let me take it way back first, and then we'll speed up.
Yeah.
Um, so I became so I was interested in baseball cards to read the statistics. I didn't really care too much about the game itself. That transition to you know I'm so old now where I would call my dad's stockbroker and place trades, and this was back in like the .com days, right?
Yeah.
So I kind of developed this love for finance and trading particularly, and then I took some different paths in my career. I was actually in audio engineering for a while. At one point, I worked for a Imperial Russian art dealer. We kind of tried a few different things, and at some point, I was like, I should just do, because I love trading so much and finance, I should actually go,
Yeah.
get my education in finance. So I did that, and just as I was completing that after going back to school, was right around 2018, kind of when that big bear market then happened. And one of my professors actually was really excited about blockchain. And he kind of brought me along into it. He tried to get me into Ripple. And so, we learned and we progressed. Um, Shortly after that, I was actually working in aviation, so I was doing a lot of statistics and kind of analyzing like when parts would break down on certain planes on certain days and all this kind of stuff. So working a lot with systems and kind of programmatic stuff. And I got a call from a recruiter at Exodus Wallet, and I'd never heard of Exodus. I don't even think I had a wallet at the time. I think I was just using an exchange account. And this was right when COVID was going on, and so like the planes weren't flying, the business was looking pretty sus. I didn't know if it was going to work out, and so crypto felt like a better risk-adjusted bet at the time. And I'm so glad that I did that because it's just been a ton of fun since then. So joined Exodus. We actually launched the first. It's debatable. It was a digitally represented version of their Reg A security that launched on Algorand back in 2021. So I came in, was helping with a lot of that. And then I started doing some of the same stat stuff that I was doing in aviation with Exodus's exchange and their asset integrations, and just really understanding the performance on that. And that led me into a product career. And kind of one thing led to another, and I spent several years as the head of product at Exodus as we did a number of different expansions and launched some really cool products. So launching new payments products that my friend Kevin over at Exodus is still running and doing really well with. And then after Exodus, I had been really interested in trying to get more into building in DeFi. I'd worked with Everstake and built a partial ETH staking product that's done really well. And I wanted to do more of that. And at the time I met my co-founder, Bill, who was leading Index Cooperative. And Index Cooperative, they started with a lot of these thematic kind of index products, right? But really the thing that found the most product market fit was these structured leverage tokens that would give you 2x or 3x exposure to Bitcoin or ETH. And that sounded like a great time, so kind of joined up with Bill. But we realized pretty quickly that we couldn't expand that product suite the way that we really wanted to, because we were limited by the underlying credit markets that we'd have access to build those structured products on. And that's kind of what leads up to the beginning of Lotus.
You've done a little bit of everything and then decided, oh yeah, I'm just gonna do crypto because that's where everything
Yes.
is.
It was too much fun. I couldn't imagine working in any other industry. It moves too fast. It's great.
But I think that's a blessing and a curse. I mean, in disguise, because it moves too fast, and sometimes you need like a break. But
no one's gonna give you that break. So
It's very true. That's why you work with other good people that can kind of
yeah,
pick you up when you got to rest a bit.
yeah. So now I want to talk about Lotus that you co-founded with your co-founder. So why did you decide to like start a company specifically like Lotus right now in
Yeah.
DeFi? Like, what pushed you to that point specifically?
Yeah. So kind of going back to what I was mentioning with the structured products, if you kind of look at the two dominant models that we have in on-chain credit today, you have the monolithic pooled model, which is Aave is the most familiar example. So Aave is actually is probably the best one currently to build these structured products on because the liquidity is so deep. And you really need that liquidity to be able to scale up these products. And you can imagine to keep a 2x or 3x leverage token within its target leverage range, you have a constant need to be rebalancing those products and drawing on more liquidity or disposing of liquidity. And so Aave is great for that. Now, they also have very conservative governance set risk parameters. And Chaos Labs, who is a fantastic risk manager for them, they kind of say, hey, on this liquidation, imagine liquidation loan to value as kind of like your axes for risk. They kind of say, hey, let's set our maximum liquidation loan to value at the point where your risk as a lender of incurring bad debt goes from immaterial to material. And so they kind of just chop it off there. So that lets you build basically a 3x, maybe a 4x leverage token, depending on how safe the collateral is. We wanted to build something that could really compete with perps, but you have much lower funding rates in these spot markets. And we thought that there was a great opportunity somewhere between the really expensive funding rates of perps and something that more of like a swing trader could hold on to for a period of time. And so the other model is the isolated model, and Morpho is the best example of that. Yeah. And Morpho, we think, has done, we love the curation model that they really championed, and we think that they really had a big unlock with that. The markets themselves, you have sort of an immutable risk parameter for each market. It gets set and then it doesn't change. Well, collateral quality changes all the time. And that could be market regime, that could be secondary liquidity. And so the appropriate leverage level or liquidation level in a particular market, BTC USD, ETH USDC, that changes over time. And it changes the further you go out on the tail of collateral. And with all of these new collaterals that are kind of coming online, as they build up liquidity and so on and so forth, they de-risk over time. So what Lotus is doing is, imagine if you had the liquidity of an Aave and you had the more precise, tighter spreads, tighter rates of these isolated models. So the way that we're kind of doing that is a tranched design where you have very senior, very predictable borrow rates and rates for lenders in the most senior zones of our market. And then you kind of go out and imagine there's like 8 different levels in this BTC USDC market. Well, the further you go out on the curve, your risk is kind of increasing, but your return as a lender is increasing. And why would a borrower want to go out and take on one of these riskier loans? Well, you might want to lower liquidation loan to value. Maybe you're getting a mortgage on a home, and the most important thing for you is to not get liquidated on that loan. You're happy to pay a little bit higher interest rate for that additional downside protection. Or you're running some kind of a trade. Maybe you're running your long spot, short perps, and you want maximum leverage because you're hedged, and there's no reason that you shouldn't be maximally capital efficient. So that's great, but hey, let's say you have $1 million and you wanted to lend that $1 million at a 95% liquidation loan to value. And that's pretty far out on the credit curve for us. And depending on where the market's at on any particular day, there could be, you could have almost full utilization locally at that tranche, but most of the time you may only have 400, 500,000 of that can actually get utilized. So in order to compensate you as a lender for the risk of bad debt that you're taking by going further out on that curve, we make a really key assumption that you would be happy for any of your unutilized capital to be utilized by the next most junior tranche, and so on and so forth, until you've been kind of fully optimized on your utilization. And so you're never lending to anything that has a higher exposure to bad debt. It's only lending to something safer. And we carry on with this until you get to the most senior tranche of our markets. And let's say that there wasn't a ton of utilization, just generally in on-chain credit in a given day. We have Lotus USD, and that's a ERC 4626 vault. Inside of the vault are tokenized money market funds. So one is the Wisdom Tree fund, and then Coinbase Prime is another that we've onboarded. And you wouldn't interact with those as a user of our vaults, for example, and you wouldn't actually touch those two assets as somebody that's in our market. But what we do is that creates a base rate for all of our markets. So you're always going to be kind of earning like the money market rate or something very close to it. And what that does is even just if you held everything else equal with these other approaches, they have a kink rate that's usually about 90% utilization, at which point the rate just starts to shoot up like a lot faster because they want to preserve some liquidity so people can kind of exit out of the market. Well, productive debt, Lotus USD, that is the actual kind of internal debt asset in our markets. So a lender is always at least earning that, no matter what the utilization is.
Yeah, and from what I can understand, you guys are going live on Q2.
Yeah, we're looking to go live in early June, so we could plus or minus a couple weeks, but yeah.
Yeah, have you guys have you had like a test net or like have you I want to know the feedback of the users.
Yeah, we actually are just launching testnet not this week, it'll be next week. We've kind of got it launched internally now. But we're really curious too. We want to make sure that we get the UI UX just right. And I'm glad that you mentioned that because there's more complexity with what I'm describing, right? And oh gosh, like how am I as a lender going to manage all these different levels? How would I know what the most appropriate level is for me to either borrow or lend at? So on the lending side, that's you kind of don't need to worry about that as much. If you're somebody that just has USDC and you want to earn a yield, you're going to have a conservative vault, a balanced vault, and more of a growth vault. And it's the vault managers that will then allocate appropriately within that mandate. But as a borrower, how do you kind of come in and not have that just be super complex? So what we've done is you come in and you say what you're looking to borrow, what your collateral is, and as you're typing it in, it will actually show you like 3 different levels that you can choose from. And it'll show you, hey, this is the safest level for you as a borrower, higher interest rate, but lower liquidation price, and so on and so forth. So you can make an informed decision without having to look at 8 different tranches all at the same time.
Yeah, so you mentioned the UI UX and everything.
Yeah.
I mean, when it comes to a protocol that's as complex as this in DeFi specifically, how do you approach that issue? Because like I've been in this industry for 6 years, and I still sometimes have I find myself Googling and researching and trying to navigate through the space when it comes to DeFi protocols, because they seem complex to me on my first, my first look.
Yeah.
So like, I mean, what's your approach towards that specifically?
Yeah, that's a great question. And I'm, having worked as a head of product at Exodus, and UI UX and great design is such a core part of how they operate. We wanted to bring that as well, right? And our target user is not sort of like your retail user. Of course, we'd love to have them. We'd love to have them contribute to our vaults, but it's more institutional. But we still wanted to bring like a really good UI UX to that experience too, because I think that matters regardless if you're putting $10 in or you're borrowing $100 million. So there's a few key abstraction layers, and then using essentially progressive disclosure throughout that experience, where the information that you need to see is always accessible, but it's not always just pushed right in front of you at every step of the process. And so that's the kind of the progressive disclosure part. Now, the abstraction piece, very early on, we had the same kind of question that you guys were just kind of hitting on a bit, which is, this sounds really cool. Am I going to be able to actually use this, right? And the thing that would be maybe the most difficult to understand is, what is your actual risk level? So as we just kind of saw with USR, with Resolve, we saw with Stream Finance and XUSD, totally different reasons why those collaterals failed. But it's still kind of this incentive within risk curators, because they don't have different risk and rate profiles to select from on high quality kind of prime collateral. So they're kind of going out on this collateral quality curve. And for us, we are saying, if you want to earn a higher yield as a lender or as a vault manager, you can do that against high quality collateral, but do it by expressing credit risk. And so now that I said that, so we've eliminated some of the need to go really, really deep on tail collateral, because you could imagine if you have 20 different collaterals, one of them could be a USR, and how do you go deep enough to really understand what that vault is allocating to? You're kind of trusting that the risk manager's done that and done it really well. So for us, with the credit quality piece, that could also be pretty complex for people to understand. And so we very early on partnered with Credora Network, who you guys are probably familiar with their risk ratings. They rate collaterals. They're doing ratings for Spark. And we partnered with them, and we wanted to have a credit rating for each of our tranches in each of our markets. But then you also get a vault portfolio rating that's sort of giving you the overall aggregate rating that includes some of the diversification and that stuff. Now, again, with the progressive disclosure, I could, if I just see the rating, maybe that's all I need, and I can go forward. I trust Credora, and I'm fine with that. If you need to learn more about that, especially if you're more of an institutional actor in our markets, you can also see probability of significant loss, and that's kind of saying, what is the probability that I'm going to lose more than 1% of my position if I'm lending at this tranche or that tranche? And so that's the kind of stuff that the institutions really need to incorporate into their risk frameworks. So we see that both as a key abstraction layer from the user experience, and then also something that's really important to onboard more serious capital.
The issue that I have with using only one risk assessment company is that I think we need more of them for one specific, let's say for your vaults, for example. If you use one and they fail, then you also have that damage done to your brand and company. Like, have you ever thought of like using 3 or 4 similar companies as well, or partners?
Yeah, so I think that's a really astute observation, and they're, right now we're really happy with Credora, and they're like a great partner, and we think that they have the right approach with this. But you're also seeing Moody's and S&P, and they're starting to come into the space and do ratings. Now, I tend to think that our on-chain native folks are going to get it a little bit more right, certainly in the beginning. But we welcome having more of those ratings as well. There's also some really cool some other approaches to the ratings, like ratings that can kind of travel with an asset across, like Particula is working on some of that. But what we do have is it kind of provides this transversal check and balance to what our risk managers are doing. And so like our risk managers, Block Analytica is running our conservative vault. They manage for Spark. So they are very incentivized to not make any mistakes. And we think they're really the best for like that conservative profile. But let's say that we had a different risk manager on like our balanced vault, and that's supposed to stay within a certain risk mandate with its credit strategies. Well, if they're deviating from that, and if they're kind of moving too far out on risk, and it's not really within what their risk parameters have been defined as, well, you have these Credora ratings that are third party and they're independent from that risk manager's own practice. And so we think that's a really important thing to kind of have that check and balance on the risk managers themselves, and to be able to provide both of those things for our users.
Believe me when I say that if this was, for example, this episode was done a year ago, I would never even think about asking this, but how AI friendly or bot friendly will the platform be? I mean, we're living in an age like where you have AI agents that control funds, and they are autonomous enough to go and use different DeFi tools and protocols. And I know you said that you're more targeting more institutional clients, but still, even institutions today are using like DeFi AI on a daily basis.
I think that's a great question. I'm really glad that you asked me about the AI bit too. So even the risk managers are using agents. Like you kind of have to, if you want to keep up and you want to be, at the top of your game in the business, you have to be able to take advantage of these tools that everybody else is ostensibly going to start using too. And so even if it's not the execution environment where the agents are signing the transactions or running some kind of smart account that's going out and executing these strategies, I think that comes in time as well. And there's, we're starting to see more of that approach. We're going to see it used all across the board, whether it's risk management, whether it's distribution. And on the distribution piece, so the yield optimizer, one of our partners, Superform, is a great yield optimizer. They have a great suite of yield products. And the way that they're planning to use Lotus is to kind of use hooks and go directly into our markets to allocate, rebalance, and add that to their certain yield strategies. Agents are doing many of the same things, right? And so you see like a Giza world, and it's really cool, like watching how fast those agents can move around, rebalance. So we're looking at that as a real distribution angle. And to make sure that you can do that, it's kind of like, can I point Claude at our docs and can it one-shot an integration with our product?
Yeah.
And that's really kind of the bar that I think we have to be at. And yeah, we're certainly thinking about that as a viable distribution path.
What about like, there's a current trend or a theme where, for example, in the United States, banks are continuously exploring on incorporating crypto in one way or another because they want to like kind of outcompete DeFi solutions. Because a few years ago it made total sense that someone would not leave their money, for example, in a bank because the return was not even covering the inflation. And they're now exploring all of these more like tokenized solutions or even DeFi, but it's not like proper DeFi. And the regulations in the US are actually favoring that stance as well. So like, how do you navigate through these like evolving regulations, especially in the United States, and to make sure that DeFi remains DeFi and not just becomes banks, so like a wolf in sheep's clothing?
Yeah, that's such a great question. So the regulation piece, I think you're absolutely right, and we still need to kind of see where the Clarity Act kind of comes in exactly and see the fine details there. But if I recall correctly, I think I just saw something about Circle acquiring Liquidity and wanting to ensure that they have a permissionless stablecoin that could, or a yield-bearing dollar coin that can give that yield that you may not be able to offer in the future on just idle stablecoin deposits. That's what the banks are saying, kind of, hey, we feel like that's unfair, and like, oh, boohoo for the banks, right? Like, we're done with that. Like, let the people have their yield. But it's the mechanism of how that yield gets generated where some of that compliance comes in. And from my understanding, active utility in DeFi, if that's an AMM pool, if that's a credit market, that's fair game. And so we feel really good about that. And then there's some other pieces too that I think are pretty big with the banks, where now they can actually put digital assets on their balance sheets or use as collateral themselves. And so that can really bring, a lot more capital into the space. But then of course it's how do you preserve what DeFi is supposed to be, right? How does it not just get co-opted by the same institutions that we built to get away from?
Yeah, exactly.
And I think that's just I think a lot of those things, it's decisions that you need to make in the product and thinking past the immediate opportunity that you have and thinking beyond that. And we've seen the Ethereum Foundation. They came out with their kind of latest roadmap and clarifying what their priorities are. And without kind of weighing in too much on that specifically, the priorities were cypherpunk priorities and, privacy, permissionlessness. And, I think that's one reason that we're building on Ethereum. We're not looking at some of these other kind of new corpo chains that are coming out. We still are long-term believers in Ethereum's vision. And so for us though, like as a protocol and making decisions where it's like, yes, we absolutely want these institutions to come in and drive the success in our business, and it actually leads to better outcomes for all the other participants when you have more liquidity in the system as well, right? So like if bad debt needs to be liquidated, you've got a really deep secondary market where that can happen, and you have better outcomes for lenders, whether it's me or you, or whether it's Tommy Joe from the bank, right?
Yeah.
So it's just a lot of little decisions though that have to be made, where you're thinking past an immediate opportunity that might be very exciting and great for your business, because it could long term, it could be the death of your business, or it could be why people don't want to use you in the future. So yeah, it's there's a lot of little decisions like that, and as we've kind of onboarded these tokenized money markets and all these different things, we really do need to think about, are people going to be able to have liquidity? What happens if an API gets shut down where there's some centralized kind of node that's has some functionality with the protocol, and making sure that there's fail safes for that, and that you're not dead in the water.
As you mentioned, institutions must come on chain. I mean, if we want mass adoption, that's how it's gonna be. Even banks, like there's gonna be this, in my eyes, there's gonna be this merging of like economies, like the digital economy and then the real economy, traditional finance. But like, do you think that we can do that while also staying true to the ethos of crypto? Just like you said, like Ethereum Foundation just came out with a roadmap, the newest one, and they did like claim that they want to stay true to the ethos of crypto by mentioning privacy, decentralization, and everything. But I mean, you see what's going on right now throughout the industry, not just Ethereum. Like money is going towards, like VCs are investing in companies that are more like centralized, and they have more control over the communities and the whole technology. So do you really believe that we can actually retain or basically maintain the original ethos, I mean, of Satoshi, let's say?
Yeah, so that's number one, that's the asset that I hold the most of is Bitcoin. And at Exodus, that was most of our customers was Bitcoin. And so I am certainly in that camp on a personal level. But I think it would be naive to say that it's not going to change. It will change, and it's not going to change uniformly for every team and every project and every application. But some of the things that we kind of held to be part of that whole permissionless model, the DAO model, for example. Well, now we have about 4 years of data that is coming off of that, and what we're seeing is that it's frankly kind of a disaster, because you end up with people that are exiting from projects over time, as will always happen, and you kind of end up with these structures that are just really difficult to operate like a real business, and to actually have clear leadership, and so there's things that have worked in the past before crypto existed. That's like, this is a common sense thing for any kind of organization. Any organization needs to be able to run itself efficiently, and sometimes that does mean some centralization. And so there's certain things that have been tried, and maybe versions of them will be tried and be really successful in the future, but it's certainly not one size fits all. And I think the space is still young enough where we're going to continue to see that evolution. I think we'll have to see in terms of how much we're able to preserve from that. Certainly we'll see assets that are able to maintain that, I think. And then we'll just kind of see where the rest of the space goes. But it's a big change for sure with the institutions coming on. It's a whole different world today than it was 3 years ago, right?
Yeah, I mean, suits and ties everywhere. So
Yeah.
it's a bit different. Yeah, so have you ever heard about the Futurkey, like the governance model?
I have, yeah. My financial engineer, Anthony, is a big fan of Futurkey.
Okay.
Yeah, I'm not as familiar with it.
Okay, the job, like, since you're not familiar, I'm not gonna go into that, but like, it's a really, really cool concept of how DAO governance can work, and
Yes.
should probably be tested in like the masses and everything. But yeah, like, I want to get into and like you guys, and how, like, what would you say would be the 3 things that make your project, your protocol, your company better than the rest when it comes to institutions? Like, how would you convince them to join you and use you instead of someone else?
The level of borrowing rates. So if you're an institutional borrower and you're putting on, you may be putting on different kinds of trades. Again, we kind of talked about where more junior opportunities are going to be the most ideal for you. And for specific kinds of trades, so these market neutral, delta neutral, basis trades, you can actually find sort of an ROE optimized point on a curve if you're a borrower, and you can refinance along that curve. And so the point on the curve that was best for that trade that you're running yesterday, you may end up refinancing some of that to a different part on the curve, and that kind of optimizes your returns. So that's something that is just not possible today kind of anywhere else. And then on the other end of that spectrum, so we are seeing this big push right now for fixed rate borrowing in DeFi. And so why fixed rate? Because fixed rate's always going to be a bit more expensive, right? You have to pay a premium for that lock-in as a lender, or you're going to expect that premium as a lock-in for a lender. And it's kind of interesting because when I worked in a lot with like the exchange business, and we would integrate different like RFQ options in an aggregator, we always had an option: floating rate or fixed rate. It was never fixed rate. We never went with that, because if you're going to swap a fixed rate, you paid that extra price to have that more stable rate. Now with credit and these credit markets on chain, especially as they're still kind of emerging and liquidity can be fragmented, you see a lot of rate volatility. And kind of going back to your agents comment, the optimizers, the agents, they get a hold of capital and they move it around so quickly, because that's what their job is. They're out there to optimize the yield. But within these models, and especially with the way some of these interest rate models work, you get tremendous rate volatility. And it can be so volatile that a borrower, an institution that needs to actually stay within some deviations, right, like on a risk model for the strategies they're running, they can't take on that risk. Or that means with that amount of risk, they have to dial down other strategies, etc. So for us, because we have now segmented and kind of, we have this precise risk curve, when you get down to the most senior parts of our markets where you would borrow at a very conservative level or more conservative level, what you get is basically you get like the funds rate plus a credit spread. And the more senior you are, the smaller that credit spread is. And it's the spread that is volatile, where money market funds, treasuries, right, those move much more slowly. It's much less pronounced. So that gives you the ability to have these floating rate borrowing opportunities where it's very stable, but you're not paying that extra fixed premium. So we're excited about that. And then the third thing that I'm really excited about is more on the vault level. And it's the idea that I can have vaults that are differentiated, going out to fewer markets, lending against collateral that I know and understand and that I would already hold in my wallet. I don't want to have to go in or have exposure to all these other collaterals. And it's just the ability to generate actual, varied credit returns against those blue chips that I think is going to be really special for our vaults. And from my, kind of my time working more on the consumer side with crypto, people just want things that they can understand when it comes to yield opportunities. They don't want all of the, all the technical jargon. They don't want to have to like go too far past the opportunity that's in front of them. And so for us, it's how do we get rid of the incentive to have things that fail in our markets and lose people money, number one. And then number two, how do we give those tools again to help them understand what the risk is without overwhelming them?
So you said you started working on Lotus exactly how long ago?
Yeah, so I think we started kind of ideating around it even 10, 11 months ago.
Yeah. Because my question was going to be like, why now? I mean, you said that, I know that the launch date is not defined yet, and it may not be in Q2 at all, for example, but like what needs to happen in 2026 for the Lotus Protocol to be a success?
Yeah.
And like, where do you envision it, let's say, by the next ETHCC event? Like, where should we see Lotus?
Yeah, that's a great question. So we should launch in June. So we're trying to hit Q2 for you. I think what a really successful outcome would look like at launch and through the rest of the year is that we prove this model, and that our curves really come to life, and that they really actually produce, and people can see that they produce these endogenous returns in our credit markets that are what I'm saying they are, right?
Yeah.
And that you can go out and get these higher rates. I think once we see that, and then once these borrowers see some of these other benefits I've described, I think it's going to be pretty fast how quickly we scale that up, especially with some of the institutional partners we have, right? Like FalconX, Dialectic. We've got some big names that can come in and move some money around pretty quickly for us. I think by the next ECC, maybe depending on the month that they have it, maybe it'll be 3 weeks later than this year. It'd be just perfect. Yeah, we see this scaling up to in the billions of deposits, you know, in the next 12 months. So I'm kind of looking for, you know, $1.5 billion in about 12 months. I would feel like we're on kind of the growth rate that I'd expect. But then from there, it's, okay, do we expand into different collaterals, or what else do we do? We don't have any plans to kind of expand out onto the tail of collateral for a while. We want to go deep on sort of these like big markets, Bitcoin and ETH. That's where 80% of all the activity is still happening today, even with all the RWAs, etc. And it's, okay, we will have a fixed rate option. And then starting to do some really interesting like collateral transformation type things. So imagine you have 3 or 4 different sort of wrapped versions of Bitcoin, or you have custody Bitcoin. Maybe you have these both in a market. Well, the redemption path then becomes sort of the extra risk layer. And you know, maybe this one, it could take a day to fully settle, and this one, there's a liquidity constraint where you may only be able to get a certain amount back, and it's being able to order those on a curve as well. So it's kind of like a redemption path curve, or doing it by oracle. So you could have a market that's ordered by market price oracle or a NAV oracle, and there could be different, you know, there's different situations where one of those would be most appropriate. Maybe somebody's very comfortable with a market oracle, and they're willing to take on, you know, what the market views as a little bit more risk.
Yeah, and also a side event by the beach as well by next year.
Side event, but yeah, man, let's have a side event by the beach. You guys will come by.
Yeah, I mean, we should be invited, right?
Yeah, like you have to like privately invite us.
Yeah.
You guys are right. I want my Kosovar's coming through. So
thank you. So, well, here's to a successful launch, and we're really happy we managed to have this conversation, and we're glad to host you, by the way. And yeah, good luck on the launch, and
thank you guys.
Thank you for joining us.
Yeah, delighted. Great to be here. Thanks.